Thank you, Miss Ivy. So for our next topic, we have here cost classification and decision making. This topic will be covering differential cost and revenue, opportunity cost, and sunk cost. Differential cost and revenue. Differential cost is a difference in costs between any two alternatives. A differential cost is also known as an incremental cost. This should refer only to an increase in cost from one alternative to another. Decreases in cost should be referred to as decremental cost. So again, pag increase in cost, ang tawag is incremental cost. Pag decreases in cost, ang ija tawag is decremental cost. Differential cost is a broader term, encompassing both cost increases or incremental cost and cost decreases or decremental cost between alternatives. Differential revenue. A difference in revenues, usually just sales, between any two alternatives. So when we say differential revenue, it is the anticipated increase or decrease in revenue in one project or investment relative to the increase or decrease in revenue of another project or investment. Put another way, it's the difference in revenue of two or more projects or investments. Differential revenue analysis is when you compute differential revenue to make your decision. Differential revenues and costs represent the difference in revenues and costs among alternative courses of action. Analyzing this difference is called differential analysis. Differential analysis is useful in making managerial decisions related to making or buying products, keeping or dropping product lines, keeping or dropping customers, and accepting or rejecting special customer orders. The accountant's differential cost concept can be compared to the economist's marginal cost concept. In speaking of changes in cost and revenue, the economist uses the term marginal cost and marginal revenue. The revenue that can be obtained from selling one more unit of product is called marginal revenue. Again, the revenue that can be obtained from selling one more unit of product is called marginal revenue, and the cost involved in producing one more unit product is called marginal cost. The economist's marginal concept is basically the same as the accountant's differential concept applied to a single unit of output. We have here an example. To illustrate, assume that the Natural Cosmetics Incorporation is thinking about changing its marketing method from distribution through retailers to distribution by a network of neighborhood sales representatives. Present costs and revenues are compared to projected costs and revenues in the following data. So, present diri ang data sa table. According to the above analysis, the differential revenue is $100,000 and the differential cost total is $85,000, leaving a positive differential net operating income of $15,000 in favor of using sales representatives. In general, only the differences between alternatives are relevant in decisions. Those items that are the same under all alternatives and that are not affected by the decision can be ignored. For example, we have here the Natural Cosmetics Incorporation, and as you look at the other expenses category, which is $60,000 under both alternatives, can be ignored because lagi walay effect. $60,000 sa ija retailer distribution, then sa ija sales representatives is $60,000 na lamang gihapon, so walay changes nga na hitabo. So it can be ignored because it has no effect on the decision. If it were to removed from the calculations, the sales representatives would still be preferred by $15,000. Para mas masabtan na atay other examples, so please look at the data given. The columns labeled Alternative 1 and Alternative 2 shows revenues, costs, and profit for each alternative. The third column, labeled Differential Amount, presents the differential revenues and costs and resulting differential profit. Positive amount appearing in this column indicate Alternative 1 is higher than Alternative 2. Again, positive amounts appearing in this column indicate Alternative 1 is higher than Alternative 2. Negative amounts appearing in the differential amount column indicate Alternative 1 is lower than Alternative 2. The fourth column shows whether Alternative 1 is higher or lower than Alternative 2 for each line item. For example, the differential amount of $1 million for revenue indicates Alternative 1 produces $1 million more in revenue than Alternative 2. The differential amount of $750 for variable costs indicates variable costs are $750,000 higher for Alternative 1 than for Alternative 2. Notice that the differential amount for profit is negative $20,000. This indicates that Alternative 1 results in profits that are $20,000 lower than Alternative 2. Thus, Alternative 2 is the desirable course of action. Notice that the columns labeled Alternative 1 and Alternative 2 shows information in summary form. Example, no details are provided for revenues. Variable cost or fixed cost. Some managers may want only this type of summary information, whereas others may prefer more detailed information. It is important to be flexible with the format to best meet the needs of managers. So, sa kanina scenario, nganong ang information naman sa variable cost and fixed cost ang ginahatagan nila ng focus, it is because we are talking about cost classification here for decision making. Then we have opportunity cost and sunk cost. When we say opportunity cost, it is the potential benefit that is given up when one alternative is selected over another. So the idea of opportunity cost is a major concept in economics. Why? Because opportunity cost represent the potential benefits an individual, investor, or business misses out on when choosing one alternative over another. So understanding the potential missed opportunities foregone by choosing one investment over another allows for better decision making. Here, considering the value of opportunity cost can guide individuals and organizations to more profitable decision making. For example, assume that you have a part-time job while attending college that pays $200 per week. So if you spend 1 week at the beach during spring break without pay, then the $200 in lost wages would be an opportunity cost of taking the week off to be at the beach. Opportunity costs are not usually found in accounting records, but they are costs that must be explicitly considered in every decision a manager makes. Virtually, every alternative involves an opportunity cost. On the other hand, we have sunk cost. Sunk cost is a cost that has already been incurred and that cannot be changed by any decision made now or in the future. So, sunk cost. It is the difference between money already spent in the past and potential returns not earned in the future on an investment because the capital was invested elsewhere. Because sunk costs cannot be changed by any decisions. They are not differential cost na pwede ma-change ang decisions, right? And because only differential costs are relevant in decision, sunk cost should always be ignored. Why ignored? Kay lagi, dili man ma-change ang ida decision. So, to illustrate, a sunk cost, assume that a company paid $50,000 several years ago for a special purpose machine. The machine was used to make a product that is now obsolete and is no longer being sold. Even though in hindsight, purchasing the machine may have been unwise, the $50,000 cost has already been incurred and cannot be undone. And it would be folly to continue making the obsolete product in a misguided attempt to recover the original cost of the machine. In short, the $50,000 originally paid for the machine is a sunk cost that should be ignored in current decision. For purposes of making decisions, the concepts of differential cost and revenue, opportunity cost, and sunk cost are vitally important. Differential cost and revenues are the cost and revenues that differ between alternatives. Opportunity cost is the benefit that is foregone when one alternative is selected over another. Sunk cost is a cost that occurred in the past and cannot be altered. Differential cost and opportunity costs should be carefully considered in decisions. Sunk costs are always irrelevant in decisions and should be ignored. Thank you.